Comparison is the thief of joy. Have you heard people talking about the real estate market crash and comparing it to 2008? Or maybe talking about the next real estate market boom and talking about 2020? The honest truth is we need to focus on the present. We're going to talk about all of that and more, and why we should forget about past booms or busts unless everything aligns perfectly. Let's go. What's up, guys? Jeremy Kane, living in the Denver suburbs. Today, we are going to talk about the real estate market and how everyone is comparing this market to 2008 or 2001 or past busts or even past booms. But first, please like, comment, subscribe. As always, please follow me on all the socials at Living in the Denver Suburbs. I'm super excited to bring you real estate content based on true facts and statistics. It's not just a bunch of home tours. It's actually stuff to educate you so that you're ready and you understand the market at the highest level that as it pertains to you. Okay, so let's first back the train all the way up and talk about this. What are the alternatives to buying if you are currently not a homeowner? Well, alternative one is renting and paying 100% interest and throwing away thousands of dollars every single month, every single year, and having nothing to show for it besides a roof over your head. And alternatively, if you're living in your mom's basement, that can't last forever. Even though it's free now, you're not building your own personal wealth, as when the time comes for them to move or, heaven forbid they pass away, you have nothing to show for it. That's divided up between your heirs and all of that. And so that's the problem, is you're not building your own wealth as you go, and homeownership is the number one way to do so, in my opinion. So let's move forward here. What happens if the real estate market does bust? Well, as a renter, you're waiting for that bust, right? You absolutely could purchase a home at a discount, but what does that discount come into play? Let's use real numbers for this. Let's say you purchase a $500,000 home. That's typical for first-time home buyers here in the Denver metro market. So $500,000. Say you wait 3 years to buy that home. On average, Denver appreciates 5 to 6%. We're just going to say straight up, say we have a flatlined real estate market, which even coming off of last year where we had a little bit of dip, we're seeing pretty good appreciation. But let's just say, for number purposes, say for instance, you want to purchase a $500,000 home. And as you know, homes appreciate 5 to 6% in the Denver metro area across 60 years. But say the $500,000 home, busts out and we lose 10% of value. So the home is now worth $450,000. So in 3 years, now the home's worth $450,000. That means you save $50,000 waiting for that bust to come. However, you paid on average about $50,000 a year for rent. So 3 years down the road, you've thrown away $150,000 to save $50,000. You're still at a net loss of $100,000. This is the problem with waiting for that optimal time, because we are still paying for paying for shelter and living expenses. So that is why waiting just doesn't make sense. Yeah, maybe you'll get it at a discount. Maybe we lose 10%, not saying that's going to happen, but just for example purposes, and you're still out $100,000 with that method, buying at the optimal perfect time, because it's been 3 years and you've thrown away $50,000 a year, totaling $150,000. Okay, let's flip the script. Let's say you own a home and we're talking about a bust. People are like, well, I lost all the value and all of this. Well, what happens when the real estate market crashes? Typically that's caused by job loss and hardship, which is definitely, not great. But what needs to happen is all of these homes need to come to foreclosure, and that way the inventory goes up, the demand goes down because not as many people qualify. And that's when we see a downturn and prices come down, when inventory outweighs the demand. And so with that said, what happens when homes are foreclosed on? People rush to the renting market, okay? And when people rush to the renting market, all of a sudden your rent continues to go up. And so as we kind of, take a step back, if you own a home and the market does bust, you have to pay something. So if you give up your home or you sell it or whatever, you're going to be in that rental market and your cost of living is going to be higher. However, if you decide, okay, well, I'm just going to hang on and I have that sense of security, and your monthly payment's going to stay the same, and you have to actually make some sacrifices and make sure that you can afford that monthly payment and continue making those promised payments towards your mortgage, then you have a sense of security, you have a sense of stability and normalcy. Whereas if you come over here and you say, okay, I'm done with that, or you give it back to the bank, or you sell it, whatever, and you come over here and renting, you have no control over that. So that monthly cost, you have no control over. Maybe it starts a little bit lower, but then as demand goes up, it's going to be higher and higher. So waiting for a bust, or, feeling like you have to sell your home or you don't want to buy because you might lose a little bit of value, is absolutely not the case. So that's why it's really important to understand what happens if we do get a bust. Let's turn it around. Let's talk about the boom. If you wait for the market to kind of come on the upswing, you're going to time it perfectly right when that market shifts, where you think it's a boom versus, a stagnant or bust period. Then right when you do that, if you time it perfectly, if you're ready, if you're not in a lease, if you don't have a ton of other costs to get out of your current situation, then that's great, but competition will be there. By the time you get pre-approved, you get out, you find a home, the competition is already going to be rising, because buyers are the first to know that the market is on the rise. And so if you wait for the market to kind of turn the switch, and whatever you think that is, right now we're at a pretty normal market, which is really healthy. However, if you wait for it to, be a great market and you're going to jump in at the bottom and ride that wave up, you're probably going to miss at least, first 3, 4, 5, 6 months, which is where things really turn up. Alternatively, if you get in, where it's slower or stagnant, maybe less competition, maybe seller concessions, all of the benefits to buying at this current time in the market with less competition, then you're going to be in a home and you already are ready for that equity gain. So you're going to ride that equity wave, and you're going to be better off when that market does boom. And so that's kind of the difference between boom or bust. But ultimately, it's about stepping back and seeing what makes sense for you and what are the positives and negatives. Most of the time, buying a home is laced with a ton of positives. And if there are negatives, there's always alternatives to go from there. High interest rates, you can refinance when they come down. Bust, you have stability. Boom, you're in and you're riding that wave of equity gain. So that's kind of that point. So now you say, okay, Jeremy, well, why do we watch your videos? Why is it important to follow the market? Why are past crashes not relevant? Why are past booms not relevant? Well, let's take 2 examples, the most relevant ones in our current, life cycle. 2008 housing market crash. It was inspired by faulty lending practices, meaning that people were put into loans that they could not possibly repay, or, were high risk loans because everyone was just giving money out, right? Fog and mirror. What happened is, when things just changed a little bit, the market, came back. Obviously, people lost jobs, and all of those faulty lending practices where people weren't ironclad approved in order to, withstand any economic hardships. All of those homes fell into foreclosure, right? People were leveraging all kinds of different, investment opportunities, and all of those homes where those loans were not solid came into foreclosure, causing the inventory to go up and, go from there. There's a couple things, okay? Faulty lending practices. There was a ton of regulation put in. It is not super easy to get a primary residence home loan anymore. You have to understand, you have to give them, bank statements and gift letters and letters of letters of understanding and all of those things. And they really do a pretty deep dive into your history and your credit to make sure that you are able to pay this loan back. The next part of this goes into the, foreclosure piece. We are so blessed with a massive amount of appreciation over the last 3 years in this market, with a little dip over the last 6 months, but nothing compared to the 30-40% appreciation that we saw over 2 years' time here in the Denver market. And so in the event you do get in trouble, you have options. You can sell your home. You also have a low interest rate. So if you need to move, you can probably rent it out if the market's not perfect, for you. So you got options there, which is why we see 1 or 2 or 3 foreclosures per month, even, coming to the list, not even completed foreclosures, is because everyone has those options. So we're not in a similar situation where we were, subprime loans and lending over value and all of those things that occurred in the 2008. So lending guidelines and, appreciation and lack of foreclosure, weather is huge for that piece. So let's flip the script and talk about the 2020 boom, right? This was caused by a global pandemic. We had extremely low inventory going into it. The pandemic made people kind of understand, okay, we don't want a bunch of people through our houses, so that limited inventory a bit more. We also had a boom in demand because all of the people that were living in the city, maybe renting or living that lifestyle, all of a sudden didn't have restaurants to go to, didn't have clubs to go to, couldn't, be around people, and you're in these small confined areas. Not to mention, you also had to work from home, so that loft in Lodo doesn't really suit your needs when two people have to work from home, be on Zoom calls and talk and hear and all the things. And so that's where things really, migrated out. People need more space. People wanted space from each other. People wanted space, in their homes to work from home and school from home and do all of the things, because now all of a sudden the entire family unit, whether it's, boyfriend, girlfriend, husband, wife, family, kids, everybody, moms, dads, was in one house all the time. And so people needed more space. And so there was a lot of things that really fell into place right there. The last thing, we had 2%, 3% interest rates. So affordability was high. People were able to, spend more because they have such low interest rates. And so that really affected that monthly payment. So they qualified for more, were able to offer more and win those bidding wars that, came to fruition as we got so accustomed to over the last 2.5 years. So as you can see, all of these things and these conditions have to be lined up exactly right. There's reasons why these conditions will not come back. So 2020, we're not going to see 2-3% interest rates, hopefully ever again, because that's a big problem that we have right now with lack of inventory, because people are just holding on to their homes. 2008, we had faulty lending practices mixed with, very low loan to value rates and not a lot of equity. Right now we have so much equity that those foreclosures aren't coming back. So unless everything lines up perfectly, we cannot compare right now and what's going to happen, boom or bust, to 2020, 2008, 2001, 1980, whatever it is, because all of those conditions lined up perfectly for that tick in the radar. So what do? We need to watch the trends. 60 years on average, 5 to 6% interest rate in most Denver neighborhoods. That's something that matters. Why are we focusing on the peaks and valleys of the booms and busts instead of 60 years of continued average appreciation when it comes to thinking about buying or selling? That is the point of this video. That is what I want you to do. If you have any questions, please book a call in the calendar link below. I would love to talk to you and see what makes sense for you, because at the end of the day, it's your exact situation, your job, your credit, your history, your lifestyle that matters. If it's a great time to buy or rent another 6 months and get ready to buy, I will always tell you that the sooner you can buy, the better for your longevity building wealth through real estate. Please like, comment, subscribe. We'll talk to you soon. Look forward to talking to you on those Calendly calls. Bye-bye.